Do you want to increase your credit score by paying off your debts, but you don't know what debt to pay off first? Paying off your debt is one of many strategies you can use to boost your credit score. But knowing what sequence to pay off your debts to have the greatest impact on your credit score can be a little bit challenging. Hi, my name is Vedast and I'm the founder of easttradinglife.com. If you are new to this channel, please subscribe as I'll be sharing more videos. In this video, I am going to show you how you can strategically pay off your debt in a way that boosts your credit score the fastest. Yes, every debt you have can have an impact on your credit score once paid off, but all debts don't have the same impact on your credit score. If you need to know what debt to pay off first to increase your credit score fast, then this is a video for you. So the first thing we need to do before we decide what debt to pay off first, we need to evaluate factors that affect your credit score. Now, there are 5 main factors that affect your credit score. In this video, we're going to refer to your FICO score. The biggest factor on your FICO score is your payment history. If you have a debt and you cannot pay it back, you are automatically a bad borrower. Not only do we want to give you money if you can pay off the money you borrowed. So payment history affects 35% of your FICO score. The second factor is your credit utilization. So credit utilization means how much you have spent compared to the available credit. Think about having a credit card. So if you were given $1,000 credit limit, and you spent $500 on that credit card, your credit utilization will be 50%. Having a higher credit utilization means that you are relying on debt to cover your finances. The higher your credit utilization gets, the lower your credit score becomes. Third factor is the age of your credit. How long have you been using credit account? If, for example, you opened your first credit card 3 years ago, the age of your credit will be 3 years. The fourth factor is hard inquiry. So hard inquiries appear on your credit score basically when you apply for a loan. So the fact that you are borrowing money means that you might be in financial trouble. So that's why hard inquiry appears on your credit reports and can lower your credit score around 5 to 6 points on average. The last factor we are going to consider is credit mix. So credit mix means a combination of different credit accounts you have on your credit reports. So a good mixture should have revolving credits such as credit cards or personal line of credits and installment loans such as a car loan, a student loan, a mortgage, or personal loans. Now that you know factors that affect your credit score, it is very important to understand how paying off debts affect these factors on your credit score. So let's start with the first factor, your payment history. Assuming that you pay your bills on time, you don't have to worry about your payment history. If you pay your bills on time, then your payment history is already good. And then if you have open accounts, you don't have to worry about the age of your credit. In addition, if you are not borrowing excessively, then you don't have to worry about hard inquiry on your credit reports. That leaves us with only 2 factors, which is your credit utilization and the credit mix. As you pay off your debt, your credit utilization get affected together with your credit mix. Now we are going to rephrase the question. What debt can you pay off first to increase your credit score faster? In other words, what is the debt you can pay off first so that it will have the greatest impact on your credit utilization without affecting your credit mix? Among all the debts you have, which one can you pay off first to have the greatest impact on your credit utilization without affecting your credit mix? To answer this question, we are going to evaluate 2 types of credit accounts or 2 types of debts. The first one is revolving debt. Revolving debt means that your credit account stays open even after paying off all your balances. Also, your lender renews your account over time as you use your accounts and pay them off. A good example of revolving credits, you can have credit cards. The second type of debt is installment debts. Installment debt means that you have borrowed a fixed amount of money and that money must be paid in a given time interval. Think about, for example, having a 30-year fixed rate mortgage. So that mortgage must be paid off within 30 years. In addition, you know how much you're going to be paying every month, also known as your monthly payments or installments. As you pay off your credit accounts, over time, your balance goes lower and lower and lower until your debt is fully paid off. Now, the question is, should you pay off your installment loans first, or should you pay off your revolving credit accounts first? Let's evaluate how each different type of debt affects your credit score once paid off. We are going to start with your revolving credit. So we know that revolving credits get renewed every month as you use your accounts and pay them off. Your credit limit could also be increased over time depending on the type of loan you have. Let's assume that you have $10,000 on your credit card, right? If you pay that balance all the way to zero, your credit utilization will automatically improve. Since it's revolving and gets renewed automatically over time, paying off that balance will keep the account open. So in other words, paying off your credit card improves your credit utilization without affecting your credit mix. As a result, your credit score will automatically go up as you pay off your revolving credit. This applies to credit cards and personal line of credits. What happens when you pay off installment loans? So think about having a car loan. And then let's assume that you pay off that loan completely. What would happen to your credit score? Since it is an installment loan, it automatically means that once you pay it off, yes, the balance goes to zero, but your credit mix could be affected. Why? Because once the account is paid off, the account will be closed. Closing the account will automatically affect your credit mix. Now, it does not happen all the time. If you have other type of installment loans, for example, you have a car loan, you have student loans, and you have a mortgage, paying off one of those loans will not weaken your credit mix. But if you only have one installment loan and you pay it off, that will automatically weaken your credit mix. As a result, your credit score will drop. But this drop is temporary. As the amount of debt you have goes lower, that improves your debt to income ratio, which is essential in improving your credit health. A lower debt to income ratio will help you improve your credit score over time. If you have a bunch of debts to pay off, but you want the one to pay off first that will have the greatest impact on your credit score fast, you need to pay revolving credit first, because as you pay them off, your credit utilization will improve, but your credit mix will not be affected. As a result, your credit score will go higher. It will only take 30 to 45 days for your lender to report your payments to major credit reporting agencies, which are Equifax, TransUnion, and Experian. Once they have your payments, these updates will be reflected on your credit reports and your credit score will go up. How can you pay off your revolving credit accounts? Let's say that you have different credit card debts. Which order should you pay off your credit cards? Credit cards are known to have one of the highest APR in the lending industry. So which means that the more balance you carry on your credit cards, the more it costs you in interest charges. And most credit card interest are compounding interest. If you don't take action, your credit card debt can grow exponentially. For this reason, if you have multiple credit card debts, it is important to start with a credit card with the highest interest first. Since your main goal is to boost your credit score, it is important to allocate more payments on the credit card with the highest balance. So look at all the credit cards you have and see which one is weighing down your credit utilization. By paying off a credit card with a higher balance, you will automatically have a greater impact on your credit utilization, which means that the faster you bring that balance down, the faster your credit score will go higher. And of course, it depends on how long it takes your lender to report your payments to credit bureaus. But this is one way you can increase your credit score. What are other ways you can use to improve your credit score? The following is a list of other strategies you can use to boost your credit score. Number one, you can become an authorized user of a credit card account. To become an authorized user of a credit card, you simply need to find somebody with an established credit history with a good credit score. Then they add you to their account. Any activity they make on their credit accounts automatically gets reported to your credit reports too, which helps you boost your credit score. Number two, clean up your credit reports. Each credit bureau is required by law to give you a copy of your annual credit reports once in 12 months. You can easily get a copy of your credit reports from annualcreditreports.com. Once you get a copy of your credit reports, what you're going to do, you are going to read that credit reports line by line. If there's anything that is not correct, if you see like inaccuracies, you see fraudulent activities, or if you see removable negative items on your credit reports, these items can be disputed to major credit bureaus. All you have to do is submit an official dispute letter to major credit bureaus and also your lenders. If your request is valid, they will delete these items from your credit reports. Once your credit reports are updated, you should see a major increase in your credit score. Number three, you have to keep your credit card open. Now, there are times when you're going to have a credit card that you normally don't use very often, or you feel like you don't need. For example, if you recently graduated and you had a student credit card and you feel like you no longer need it, you don't need to close that credit card. This is because closing that credit card can weaken your credit mix. As a result, your credit score can go lower. If you don't need that credit card, instead of closing the account, what you can do, you can put a small payment on it. For example, a Netflix payment on the account. This will keep the account open. Number four, pay your bills on time. Now, payment history, we have seen that it is the biggest factor on your credit score. So no matter what you do, you have to pay your bills on time. Always on time. If you have, no matter how many accounts you have, every account you have to make sure that every month you pay the minimum, at least the minimum payment necessary for that account. You don't want to have a late payment or miss a payment on your credit accounts. Number five, avoid excessive borrowing. Now, when you go to your lender to apply for a loan, usually the lender requests to view your credit reports and a credit profile. This results into a hard inquiry on your credit reports, and that lowers your credit score by 5 to 6 points on average. So if you want to boost your credit score, do not borrow excessively. Number six, watch your credit utilization. If you are in the process of increasing your credit score, it is not a good idea to spend excessively on your credit accounts. So any amount you spend on your credit cards, unless you pay them off before the due date each month, that amount will get carried over to the next payment period, which contributed to your credit utilization. In order to keep your credit score up, you have to manage your credit utilization. So most lenders suggest a 30% credit utilization, but this is a huge percentage. If you want to have a very good credit score, keep your credit utilization under 10%. So that is, if you have a credit limit of $1,000, you should not spend more than $100. I recommend to always pay off your balances in full before the due date every month all the time. So that means you're not carrying a balance to the next payment period, which means that you're not paying any interest. So to recap, if you want to increase your credit score by paying off your debts, first pay off revolving credit accounts first. Paying off revolving credit have a direct impact on your credit score. This is because paying off revolving credit accounts automatically improve your credit utilization without affecting your credit score. This directly boosts your credit score. Paying off installment loans will have a less impact on your credit score. Matter of fact, it will drop your credit score temporarily if paying off those debts weakens your credit mix. If you like this video and you want more videos like this ones, subscribe to my channel and visit my website. Thank you.